So welcome everyone. This class will be extremely informative and extremely useful to day-to-day scenarios on how to use standard deviations. We're going to cover what is standard deviations, how to use them to your advantage, which Price likes to use, what each level means, and different hacks and shortcuts to standard deviations on how to understand them in a much more simplified way. So to start, we're just going to simply talk about what is standard deviations and what exactly it is we're even looking for. Why do we even want to use them, basically, is what we're about to talk about. So to begin, we have to start extremely simple. So what standard deviation simply is, it helps you to determine any roadblocks on the way from point A to point B. So what does that mean exactly? Say we're just moving up, we'll just draw it straight up like this. Okay, so let's start simple, right? We're simply trying to start from point A and we're trying to get to point B. Okay, simple. We want to say, for example, you're waking up in the morning, you have to go to work, you're starting from your house and you're trying to get to work, point A to point B. Okay, what standard deviation helps you with, it basically tells you any roadblocks along the way, because we know the market does go from point A to point B. However, it has multiple pullbacks. So the market, when it's trying to go from point A to point B, realistically, it will do something like this until it reaches point B. But it's the same thing. It's still point A to point B. But you can see there's multiple little waves. It moves in waves pretty much, okay? Standard deviations help you predict very accurately when these waves will occur, when we're going to get the pullbacks, or when we're going to even bounce from getting the pullback. Okay, that's what standard deviation's job is to help you do. To simplify it even more, say, for example, you're going to work. You start from your house and you're trying to get to work. Google Maps, for example, is a tool that you can use to help you say, okay, is there going to be traffic? Is there going to be an accident on the way to your job? And so when you're trying to get to your job, there's some traffic, so it's going to take you a bit longer to get there. It's going to take you, a couple extra minutes to get there due to traffic or, any other circumstances. And that's exactly what standard deviation is. It helps you determine when there's going to be traffic. But yeah, standard deviation helps you determine the traffic from point A to point B. It's simple. You're trying to get from your house to your job, but there may be traffic along the way. You'll use Google Maps. In this sense, standard deviations are Google Maps, basically, to help tell us, is there going to be traffic? Is there going to be accidents along the way to work? And that's exactly why it's so useful, because it helps you determine exactly when we're going to get the pullbacks, when exactly we're going to stop, or potentially even reverse before even getting to point B, because sometimes we don't quite make it to point B. Sometimes we'll just turn all the way back around, and that's exactly why standard deviations is useful. Okay, so moving on, now we're going to talk about what exactly standard deviation is, like what to look for when you're looking for standard deviations. Okay, so next we're talking about what to look for when you're looking for standard deviations. What exactly is it? How does it tie into what we already know about ICT and the markets, right? So simple and plain, standard deviation is we're looking for a manipulation leg. Okay, and so some people may know that already, but this ties directly into AMD. So what I'm about to do now is I'm about to draw an AMD example. So this little part right here where we kind of consolidate would be our accumulation, and we manipulate down like this, and then distribute right back up to the upside like this. And same thing for a bearish example. It's very similar. So what we have here, this is AMD. This is exactly how standard deviation works, okay? We accumulate here, manipulate down, creating basically a jagged move, and then we distribute right out of that jagged move and continue in the same direction for the most part. Of course, while moving from simply, this would be our point A down here. Even though it's manipulation, it's still point A. We're trying to get it to point B somewhere way up here, okay? So it's still the same concept, point A to point B, once we get the distribution, okay? Standard deviation's job, what you need to be looking for, we're simply focusing on the manipulation half, okay? We're only focusing on this, because standard deviation, when you draw it, your job is to simply grab the manipulation leg, which means we're only here to focus on the manipulation. And same thing here with the bearish example. This would be our point A. to try to get to point B. So yeah, we're trying to get from point A to point B here in a bearish example, and the distribution will be always bigger than manipulation. Okay, so I'm actually going to write that part down too because it's extremely important. Okay, so the distribution phase will always be bigger than the manipulation, okay, or just the manipulation leg. What I'm trying to say here is that even though we move down like this, the up move right after should be a lot bigger. And why is this? It's because the market consolidates here. It fakes people out to make them think that we're going up. We slam it all the way back down to then make people think, okay, hey, well, that was the fake move up. We're going to drop it down now. And as soon as people think that we're going to drop it down, they slam it right back to the upside. And that way it takes out both people who are thinking, okay, they caught the real move. They both got stopped, and it makes people not want to trade anymore when all we're going to do now is go in that same direction for the most part. Okay. Same thing with the bearish example. We accumulate here, manipulate out of the range to trap people into thinking we're going long. Then we just dump it all the way back down for the shorts. Okay. And once again, standard deviation occurs where we're only looking for the manipulation. So how would you draw standard deviation from this example? This is where we're looking for the manipulation half. You simply would find your fib. You start at the bottom. For a bullish example, you start at the bottom, and then you move it to the top of this little hump. Okay. When we're looking for manipulation, we simply put our fib, our 1 at the bottom. That's our starting point, and the 0 at the top of this jagged move to represent the manipulation half. What we're looking for. We're looking for the manipulation leg. And this will tell us how far we can go for the distribution. Meaning, remember what I said, the distribution will always be bigger than the manipulation. That's exactly why we're trying to get it all the way up. Now, you may be thinking, well, where's our point A and point B from this little weird looking ladder thing, right? Okay, so your goal for standard deviation is the same way that we're looking for point A to point B. Your point A is the 0. That's where we start. The point B is your -2. Okay, your goal is to basically get to work. You're starting from home. You're trying to get to work. No different than that, how we started off. Except in standard deviation, your ultimate goal is to get to -2. Okay, you want to position yourself to be in a trade before we get to -2 because that means you're already at work, right? There's nothing left to do once you're already at work, right? Point A to point B. That's what your goal is. You start at the 0. We're trying to get it to -2. Okay, simple as that. And same thing with the bearish example. We would simply start at the top like this. Remember, the 1 is where you start, and then you put it down like this, and your 0 is down here. And so your goal is to get from point A to point B like this. And point A, remember, is the 0. Point A is the 0. Even though you start the standard deviation right here at the 1, their point A is the 0. The point B is -2. But yeah, guys, your goal for standard deviations is to get from the 0 as your point A and -2 as your point B. Now let's talk about what this actually looks like on a chart and why this is so useful. So to do this, I'm going to find an example. We are on the 5-minute right now, and we're going to try and find a manipulation leg. Now, to do this, it's very, very simple. All you have to do is go in the line chart. And what we're looking for is basically any jagged move where it looks like extremely like a mountaintop or a mountain low, so to speak. Basically, a Disney logo. Think very simple and plain, okay? What does a Disney logo look like? It looks like a mountaintop, pretty much. It looks like a mountaintop. So it's something like this, right? Almost like a crown. Like if you put like something like this, it would look like a crown, okay? Or mountaintop, or anything along like Head and Shoulders, basically. That's exactly what this is. So this is basically us looking for a Head and Shoulder pattern at every stage, okay? So even if we bounce like this, we would be looking for the same like mountain low. Basically, your inverse Head and Shoulder, something like a mountain low. You can see like this is like the bottom peak, and then that's what we're looking for, okay? And if you're thinking back to like the Disney logo, you would simply, this right here would be like your shooting star above like the Disney logo, so to speak, right? That's what we're looking for here. That's all we're looking for, okay? And the line chart, once again, is your cheat code for this. So all we're doing is we're going to start looking for mountaintops everywhere that we see. Okay, don't overcomplicate it. That's another thing. Do not overcomplicate it. Okay, so if we're looking for a mountaintop, from what we have here, I could say, okay, this kind of looks like a mountaintop, like this, right? And you can see all I did for that is I simply started at the top like this and moved it to the nearest hump. Okay, and now when we put it back in candlestick form, what we need to see is a set of bullish candles. If we're looking for a bearish standard deviation, we need a set of bullish candles. If we're looking for a bullish standard deviation, we need a set of bearish candles. Okay, we're going to go over multiple examples of this. But when I put it back in candlestick form, you can see we did grab 2 bullish candles, and it ends at where this last bearish candle is as well. Okay, I'm going to say that again. We have 2 bullish candles here, but where our 0 is, there's a bearish candle. Okay, we'll talk about why that's important as well in a minute. But you can see what we basically did here. If we're looking for point A to point B, the 0 is our point A, the -2 is our point B. We're simply moving from the 0 to the -2. And what does it do? It basically, if I put a box right here, you can see that's kind of where we bounced. Now, it's not exact because the candles do kind of dip beneath it, but if I put it back in the line chart, you can see it's kind of, it holds pretty decently, right? Now, your goal is to get the -2. However, we can create new manipulation legs everywhere. Remember, we're looking for every single jagged move. That's how you can use this. And so if we're looking for every single jagged move or every single mountaintop, so to speak, this right here would also be one. Once again, I'm just putting it at the one, or starting at the top here and moving it to the nearest hump that we see. And then we're looking for it to go from 0, which is our point A. Remember, this is point A at the 0 to point B at the -2. Okay, simple as that. Point A to point B. That's exactly what happens here. And if I put a shaded box on -2, you can see that's exactly where we went. Okay, that is the goal. We're trying to get from point A to point B. And what do we have when I put it back in candlestick form is we have 2 bullish candles with a bearish one right here at the 0. And then we make it our way down to -2, also pretty much without sweeping this high. Okay. The thing about standard deviations is we are basically picking the tops and the bottoms of the market and saying whenever we have a bearish standard deviation like this, we're saying that this is the top and we shouldn't break past this. We basically should just keep going all the way down to our point B from here. That's what you're saying. Whenever you draw standard deviation, we are looking for it to be the top or the bottom of whatever structure we're looking at. In the same way, if we hit this point B, we're going to be looking for a new standard deviation back to the opposite direction. Okay, and so what we have here is another jagged move at the bottom. Do not overcomplicate it. We're going to start at the bottom like this and move it back to the nearest hump like this. And this would be our 1 at the bottom, and our 0 like this. Okay, they may be wondering, well, it looks kind of simple the way he's doing it, but when I'm going to do it myself, it may be a little bit different. I forgot what he said. The one thing that you need to remember when you're drawing your standard deviation, when you're actually anchoring your fib level, you have to do it backwards. What do I mean by that? I'm starting here, but I'm only going to the left. So I'm going to zoom in so we can all see it. I'm starting down here at the bottom, but I'm only going to the left behind me. I'm not going forwards. I'm not going to the right. So the wrong way to do it is like this. I'm starting at the bottom, but I'm going to the right. You see how I'm only moving my mouse to the right side. The proper way to draw standard deviations is everything behind you to the left. So I'm starting here and I'm moving backwards to the left. Never go to the right. Okay, if you find yourself going to the right at any moment, you're drawing it wrong. Okay, it's always behind you. You're looking in the past. Okay, and once again, we're looking from point A at the 0 to point B at -2. And you can see in the line chart, it looks like we don't quite hit it, but I'm sure in candlestick form, you could see we wicked basically right up to that -2. That's our point B. Simple as that. What did I do to set up the standard deviation? Here, I'll screenshot it. So once again, the line chart is your cheat code. You simply need to find the line chart. And how do you get to the line chart? You simply just go on the top right next to indicators, this little drop down arrow here. You find the one that says line, you put a star by it so you can get to it easier. You don't have to do the drop down menu every single time. You put a star by it, and then it'll be right here. You can easily flip from candlestick to line chart every single time. Okay. Remember what we're looking for, guys. We're looking for the Disney logo. We're looking for the Disney logo. That's it. The mountain top or the mountain low. Simple as that. Do not overcomplicate it. If I zoom in here, you can see it's just a jagged move at the low, like a bottom. And we're just simply looking at the nearest hump that we see. That's it. And that's where you put your 1 here at the very bottom and your 0 at the nearest hump. That's it. That's all we're looking for. Okay, remember, to the left, we're doing it backwards, never forwards. Always backwards. Let's go over a bit more examples so we can really get the hang of it, like what it looks like in candlestick form, because on the 5-minute, when we put it in candlestick form, you can see there's really only 2 bearish candles here. Why is that important? It's because when I said you're drawing your standard deviation, you want it to be a set of bearish candles followed by a set of bullish candles if you're looking for a bullish standard deviation. But when you're looking for standard deviation, guys, you have to find a set of bearish candles. If you're looking for it to go up, you need a set of bearish candles. If you're looking for it to go down, you need a set of bullish candles. Why is that? Think back to the example of the thing I drew with the AMD. This is a fake out, okay? The bullish candles is the fake move. We're looking for it to go the opposite direction, the distribution, right? It's because it's fake. Manipulation leg, it's kind of in the name. This is a fake move. It's manipulating everyone into trying longs when really we're going to go short, okay? And that's why this is so useful, because you should always be looking to trade in the direction of your standard deviation. Once again, if we're going from point A to point B, if this is the 0, remember, is our point A. If we're going from point A to point B, which means we're moving up, right? We're going like this. Why on earth would you try to short? You'd be going the wrong direction. If we're going to point A to point B and it's up, why would you short? That's also why standard deviation is so useful, because it keeps you in the same direction without you having to flip your bias, because we haven't even hit point B yet. So that's why it's so useful. So now what we're going to do is we're going to go to a lower time frame and see if we can spot this, because I want to make this very, very clear, because you can't really see it on the 5-minute that well, because the higher time frame that you go, the less obvious it is. But this right here I'm trying to explain. So let's actually break down what exactly we have here. I am on the 30-second chart right now. We're going to go over multiple time frames, because standard deviation does not stop on one time frame. It works on every single time frame, including the daily, including the weekly, including the monthly chart, no matter what asset class you're looking at as well. It works on stocks, it works on crypto, it works on everything. So to start, once again, what's our cheat code? It's the line chart. We're simply flipping it into the line chart, and we're looking for, once again, the mountain top, or the jagged move, the most obvious mountaintop that we see here. And if what we can see here, this right here looks like a mountaintop to me, right? Remember the Disney logo thing. This is what we're looking for. Think about the shooting star on Disney logo. That's what this is right here, okay? And so all we're going to do is we're going to put the start at the top like this, and we're going to move it to the nearest hump like this, right? And so you can see here, we basically, when we put it back in candlestick form, it looks like this, like 2 bullish candles. And then we start moving lower. Now, remember, point A to point B, we're trying to start at the 0. Is our point A. At the 0, it's kind of hard to see. But just imagine this point A is at the 0. And then we're trying to get it down to -2. Okay, now we didn't quite make it to -2, or maybe we hit it to the absolute tick. It's kind of hard to see. We just barely missed it. Okay, we just barely missed it. Now this does happen sometimes, but you see how close we get. Okay, we'll talk about why we kind of stopped. But we basically got near point B. And what happens when we get to point B is we basically get another kind of mountain low type of thing. Okay, now where does that send us? If we were to do this right here, and we're trying to get from point A to point B, this would be, once again, the 0 at point A to point B, the -2. Remember, like, we're going to work. Simple, point A to point B. Do we get to point B? It looks like we do. And once again, that's our goal. Our goal is to get it from point A to point B. Now, if you're looking at PD rays, of course, there's no entry. That's actually one thing I forgot to mention, is that when you're using standard deviation, we're not looking at PD arrays at all. Okay, this is stepping outside of you looking at a PD array. I want to make that very clear. We're not worried about the bearish gap here. We're not worried about this bearish gap here. Of course, some people can't see it, but this right here is a bearish FEG. This right here is a bearish FEG. When you're using standard deviations, you're not worried about the PD arrays at all, because we're simply looking at point A to point B. That's it. We don't care about whatever's in the way, because we know it's going to get there. Think of it as, I wouldn't say it's super guaranteed every single time, because nothing is 100%, but think of it like as you're forecasting the weather. The weather app or whatever you're using is going to be extremely close to what the weather actually is for the day, even if it doesn't rain at the exact time. Say, for example, it says it's going to rain at 2 p.m. today. Okay, the rain's not going to start exactly at 2 p.m., but it's going to start maybe 15 minutes after 2 or before 2. It's going to be super close, and that's exactly what this was down here. We got super close to the -2, but we didn't quite get it there. But the forecast was very extremely close, and that's good enough. Okay, now this one right here, we do get to -2, and we stop here. We'll talk about why that is in a second. And then we basically come back down. Now, what this is, you can see when we come down, we have nothing but bearish candles. When you're using standard deviations, what you need to start training for, like having your eyes trained for here, is basically whenever you see a set of bearish or bullish candles, think back to what I just put in the notepad. Okay, if we're looking for a bullish standard deviation, we need a set of bearish candles, right? A set, meaning at least 2 or more, at least. Right here, this is a set of bearish candles. Okay, the second half of what this is supposed to be is you need a set of bearish candles followed by a set of bullish candles, meaning you have bearish candles down, you need some bullish candles right back up until we close past the hump. Now, I know you can't really see the hump here, but if, once again, the line chart is our cheat code, you can see this is kind of like a jagged move right here. And then we're going to try to close back above it. Once again, multiple bullish candles. Okay, so to finish what this actually is supposed to say, you are looking for a set of bearish candles followed by a set of bullish candles until we close back above the original hump that started it. What that means is if we had this as our standard deviation to the upside, when we put it back in candlestick form, we had 2 bearish candles followed by 1 fat bullish candle that closed back above the original hump. It's all about closing back above the original hump, basically. And that's kind of what we have here. We have a jagged move down, little mountain low. It's kind of hard to see, but then we put it like this. We're just putting at the nearest hump. Once again, it's very simple. This little hump down here, this little hump right here. Don't overcomplicate it. Do not overthink it, please. You put it like this. Remember, backwards, we're looking to the left. That's our 0. Once we have it like this, we're looking for price. When we put it back in candlestick form, we need to see something like bearish candles, a collective set of bearish candles when we put it back in candlestick form, followed by a new set of bullish candles. That is your standard deviation. Okay, that's how you know you're actually having a right or real manipulation leg. When you put it back in candlestick form from the line chart, of course, it's easier to see it on the line chart, the little jagged move. Once you put it back in candlestick form, you have to see the set of bearish candles followed by bullish candles. You have to see it, okay? If you don't see a set of bearish candles here, that means you likely do not have a real manipulation leg. That's what that means. And once again, the goal here is to get from the 0 at point A to -2 at point B, okay? And once we start moving up like that, you can see we do make it to -2, and we go past it. Okay, we're going to talk about what all that means and stuff in a second, but we basically got there and then some. That's a good thing. And if we are looking back to the downside, what would we need to have? We would need to see a set of bullish candles followed by a set of bearish candles. Once again, the line chart makes it a bit more obvious because you can't really see that. Once again, in the candlestick form, it looks pretty crazy, but you put it back in the line chart, it's a bit easier to spot. That little jagged move at the top, we start here and we're just putting at the nearest hump, not overcomplicating it. And then we start trying to get to point B. We start at the point A, once again, the 0 up here. And then we're trying to get it to point B to -2. And do we make it there? Not really. It looks like we kind of played around a bit. We actually stopped at 1.5 instead of -2. Once again, we're going to talk about what all that means in a second. Remember, it's like a forecast, right? The weather, like I said, it's going to tell you when we have the highest chance for rain, but sometimes the rain is almost delayed. Sometimes we don't get the rain at all. but it's a forecast. What we're doing here is basically forecasting where price is about to go next, or we have a very high chance of going next. So we're going to go over one more example of what to look for when you're looking for bullish candles followed by bearish candles. So to show you that this works on every single time frame, now I've moved up to the 1 hour. We're going to start in the line chart and look for a jagged move, okay? The mountaintop, so to speak, the Disney logo, right? That's kind of what we have here at the top. It looks like a mountaintop, and then we kind of go down, okay? This right here, the mountaintop, would be like this. Once again, why am I drawing it like this? You may be thinking, well, Plyo, didn't you say like the nearest hump? There's kind of like a little hump right here, right? Some people would say this is hump. Remember, when you go in candlestick form, your job is to grab the collection of bullish candles. Well, you can see on that little hump that looks like there's in the line chart, there's no bearish candle here, which means we have the whole set of bullish candles here, which means it's going to be down here because that's where pretty much the bullish candles end. Okay. Now, this one is kind of confusing a bit, just a little bit, because you may be thinking, well, Plyo, the bullish candles are really until here. But once again, the line chart is what you're really drawing this off of. Okay. I do not draw standard deviations off the candles itself. I draw it off the line chart. It's a common misconception. People think that I'm drawing it off the bodies. I'm drawing it off the line chart. This right here, if our goal is to get it from point A to point B, we start at the 0. Remember, that's point A. We're trying to get it down to this -2 pretty much here. And you can see how close we got. We got probably within, I'd say that's like 10 points, legit like 10 points away. That's actually 7 points away. That's really good. On the 1 hour, once again. Now, this is supposed to be extremely precise, and most of the time we do hit this -2. I think, we do come back for it eventually. But the thing that makes it so useful is that you can even predict how far this up move is going to go. Because why am I saying that? This right here would be a new manipulation leg to the upside. Why is that? It's because we have 3 bearish candles followed by what? A bullish candle. Okay, that closes above where that little hump that we started at. So all I'm doing is simply putting it at the start at the bottom. I kind of did that too quick. We'll start at the bottom like this, and we'll put it at the nearest hump. Once again, when we put it back in candlestick, what are we supposed to be looking for? We're supposed to be looking for a set of bearish candles followed by bullish candles. In this case, it's just one singular candle, but that's even better because it gives us exactly what we're looking for. And our goal is to get it from point A to point B. Let's just fast forward this so we can see. You can see we stopped at -1, basically to the absolute tick. Okay, that's why this is extremely useful, because sometimes on the higher time frame especially, we don't always go to -2, but we stop at other levels, and that's exactly what's going to lead us into the next point, is what the levels actually mean. But you can see basically we stopped at -1 here to the absolute tick, and then we start coming all the way back down. And like I said, we start down here, and then we move it up like this. Once again, you may be thinking, well, Plyo, that looks a bit too complicated. If it looks complicated to you, all you have to do is put it in line chart and look for that little humps. That's all we're doing. So now let's talk about what the levels actually mean. What does standard deviation levels mean? You can see here, we basically have a 1, a 0, -1.5, -1, -1.5. It basically goes all the way up until we get to -4. And you may be wondering, well, Plyo, why do you have it drawn like this? Once again, I've been doing this for a very long time. I already know what it looks like from the line chart. You can see it's kind of like floating above the candle there, but when you put it in line chart, it's actually at the hump, right? Remember, I'm not drawing it from the bodies. I'm drawing it from the line chart. What does standard deviation levels mean? What do they do? What should we look for, or what should we expect once we get to the 0? The 0 confirms your standard deviation leg is real, okay? What does that mean? It means you're looking for a close above the 0. Keep it simple. We're just looking for a close above this, okay? Now, you can kind of rank this into tiers, basically. So like tier 1. So tier 1 for the 0 is if we close above the 0 on the first try, and you want to see us stay above the 0, basically. So tier 2 would be if it took us a little minute to close above, but we finally do end up closing above. What does that mean exactly? We'll find one later. But basically, it's just if it took us a little minute. Say, for example, this one bullish candle didn't quite get there, like maybe we stopped right on it here, and then the next couple of candles finally got closed above the 0. That's tier 2. Okay, so tier 3 is what you don't want to see. So tier 3 would be if we did this. We get one candle closed solid through it, but then we just drop right back down beneath. Okay, you do not want to see that. A good example of this tier 3 is this bearish example. Remember, if we're looking for a set of bullish candles followed by bearish candles for standard deviation, you can argue that this would be a bearish manipulation leg. Why is that? It's because this right here is obvious, like a mountaintop. And once again, you put it in candlestick form, it's nothing but bullish candles, right? Followed by a set of bearish candles. That's exactly what we're looking for. Remember, think back to this. Remember, for a bearish standard deviation, all you need is a set of bullish candles. That's what we have here, followed by bearish candles. Now, think back to this, tier 3. Let me get rid of this right here. Think back to tier 3. What you do not want to see is us close beneath the 0, but fall back beneath it, or basically, in this case, go back above it, because we're looking at a bearish example. You can see we close beneath the 0 here, but then the very next candles are bullish back to the upside. What does that mean? It means that this is probably going to be a fake manipulation leg. Okay, you want to see us close above the 0 and stay above it. Okay, so I'm going to add that on to the point here. So we have to close above the 0 and stay above it. It's very crucial that we stay above it. That's exactly why this one would be the real move, or has a very high chance of being the real move, because you can see not only did we close clean above it on the first try, which is tier 1, but we also stay above it with more candles. If I keep playing this out, you can see we kept going up, which means we have a very, very high chance from going from where? Point A at the 0 to point B being a -2. Remember, the entire goal of this is to get from point A to point B. Okay, if we close above the 0, we have a very high chance of getting to point B. Simple as that. Remember, keep it simple. If we're looking for it to go up, we should never try to fade the direction of standard deviation. Okay, this is a bullish standard deviation because we were looking for it to go up. Imagine that the standard deviation was green. I know it's kind of like clear or like gray. Imagine this is green. If it's green, that means we're bullish. Do not take shorts until we get to point B, or at least -1. We'll talk about what that means as well. But this is what you're looking for the 0. You need to see us close above the 0 and stay above it. It's very important that you see us stay above it. Extremely important. To go even deeper into what the 0 actually is, we have to talk about what PD rays form, because I know some people are thinking, remember I said how you have to ignore the PD rays for standard deviation because you're kind of looking past them. But if you actually are looking at the PD rays that form at the 0, actually there's 2 PD rays that form at the 0 every single time. Okay, so what PD rays form at the 0 every single time? It would be 2 of them. Every single time you're supposed to get an OB and a breaker. Every single time. If we're looking at this as a PD ray, what do we have here? An OB, this bearish candle. And then we have a breaker being the bullish candle. Now, to simplify this even more for the ones who don't really know what a breaker is, this will be extremely helpful for you as well. To even identify what an OB or breaker is, you can simply just use standard deviations. Okay, I'm going to explain that a little bit better after I explain this part, but listen very carefully what I'm about to say. The OB will be the opposite color as your standard deviation. Remember what I was saying. Imagine this standard deviation was green instead of like gray. Let's see if we could change the color just a bit. Okay, that's kind of better. Okay. So imagine our standard deviation is green, like it's kind of like a dark green here, so it's easier to see. But your PD ray at the 0, remember, this is a 0, you should get an OB, right? If we're looking at green for bullish, my candles, instead of being green, they're blue. So that means the bullish candles are blue, the bearish candles are black. Your OB is the opposite color of your standard deviation, meaning we have a bullish standard deviation. The OB here is going to be the bearish candle, right? It's just the opposite color. The breaker is going to be the same color as your standard deviation, or basically the same direction you want it to go in. Okay, what does that mean? So we have the OB here, the bearish candle, and then the breaker would be, so I'm going to actually move this standard deviation just slightly over so we can see it better. So the OB would be the bearish candle. The breaker would be these 2 candles here. We'll just make it green. These 2 bullish candles right here would be your breaker. Okay. Now, I'm not going to explain what a breaker actually is. You just have to kind of know for yourself. But all you need to know is these 2 bullish candles are going to be your breaker. The breaker is going to be the same color as your standard deviation. The OB, the opposing color, meaning it's the bearish candle because we're looking for a bullish standard deviation. Okay. Now, these 2 PD rays form every single time you draw a standard deviation, which means just from us closing above the zero alone means you should have an OB and a breaker, which is, of course, a strong signature in the market that we're going to actually continue that same direction. Remember, that's how AMD plays a part in this. It's how market maker models play a part in this, all that kind of stuff. The third PD array that can sometimes form is an FVG. So sometimes there's an FVG. This example is perfect because there's an FVG here. So if I remove this just a little bit, actually, we'll just make this like a different color. That'll be easier. Make it purple. Okay. So imagine our breaker now is purple. The third PD array that forms here is going to be the FVG. You can see the FVG forms right here. What just happened here is we have 3 PD arrays in the same exact spot, all in the basically one exact point where 3 PD arrays align to support price to the upside, which means this is kind of high probability to take. Okay, that forms at the zero. When it's super textbook, you're going to see the third PD array there. Okay, that means you should have no doubt in your mind that we're going to go from point A to point B. Remember, point B is -2. So at the zero, once again, every single time you should have the OB in the breaker. Every single time. Every single time. You should have the OB in the breaker. And then sometimes it's going to be the FVG. Now we're going to talk about what does the -0.5 do. Your displacement calculator. Simple as that. This will tell you whether or not we actually have a real displacement in the direction of where we're trying to go, to point B. If you see price slow up here at the -0.5, then we're going to slip into tier 3. That's why I saved it to Notepad. Remember, what does tier 3 mean? Tier 3 is when we close above the zero but fall back beneath it. If we stopped here at the -0.5, that would mean that we do not have enough strength to actually carry ourselves up to point B or even -1, and then we'd fall back beneath and the deviation can still be fake. So really, you kind of want to see us get from the 0 to, and also close above the -0.5, just off rip. Or if you're in a long, you maybe want to move to break even here or trim or, start trailing, whatever you do. But you want to see us close above this to have a very high chance of getting to -1. And even going back to that other example, let's see, did we stop at the -0.5 here? I don't think we did. Yeah, we didn't exactly stop down here at -1.5 or 0.5. But either way, it's still tier 3. Okay, remember, tier 3 can occur if we do not displace past the -0.5. And once again, why am I drawing it like this? I'm simply using line chart, looking at that little jagged move, the hump, the mountain low, so to speak, and putting at the little nearest hump that we have here, and that's our standard deviation. This is our displacement calculator. If we can't close above it, then we'll slip into tier 3. Once again, what's tier 3? It's when we close above the zero but fall back beneath it, and that makes the standard deviation a bit more useless. Now, one thing I actually forgot to explain about the tier 2, for example, sometimes, it's kind of rare, but sometimes when we close above the zero, we'll push up past it and then fall back beneath. You may be thinking, okay, it's tier 3 and it's going to fail, but sometimes we'll hold OTE. But just know, sometimes tier 3, it doesn't always have to fail even when we're in tier 3. Sometimes these OTE levels actually end up holding. Okay, just know that. I feel like -0.5 doesn't really need any more explanation than that, other than it's a displacement calculator. If you see us close past it, it's a very good sign that we're going to try to get to point B, or extremely close to it. Now, since we're moving on from -0.5, let's talk about what -1 does. So -1 has a very important job. So -1 controls whether or not we'll get to point B, which is, of course, -2. So -1 controls whether or not we'll get to point B or -2. And if we stop at -1, if you ever see us stop here at -1, say, for example, we just like wicked off this -1, it would mean there's an extremely, extremely high chance we're going to come all the way back down to where we started. Okay, where the standard deviation started. Not this low right here, but where the standard deviation started. It's a very high chance. I would say it's about 90% chance. Okay, why is that useful? It means that if you see us even stop here and start turning it back around or get like a new bearish OB off of this, -1, it's a cheat code. Because now you know not to even trust this bullish PD array, even though it's unmitigated, even though we still have like a daily range 50% or whatever to come back to. If we see a stop at -1, we will be dropping all the way back down to the lows. Absolutely. Okay. That's why it's such a useful thing to know. Okay, if we close above it, let's see what happens here. Look at that. We kind of wicked off at first, but then we end up closing above. Okay, cool. So we close above. then we should keep trying to get to -2. Okay, even though it looks like we stopped here for a second, we did not get a new bearish leg. When we stop at -1 and you expect it to fail, you need to see a new bearish standard deviation. Okay, you can see here there was a set of bullish candles here, but did we close back beneath the hump? No. We would have had to close back beneath this. And that's where you hear me say on stream all the time, okay, for us to reverse, we have to close above this candle high, or we have to close beneath something. That's why I'm saying that, because I'm looking for us to constantly close above or beneath the 0 to confirm whether or not we're actually trying to get to point B or not. Okay, now let's see what happens here. Do we close above -1? Yes. Does it look like we're trying to stay above it? Yes. So let's see, do we get to -2? It's looking like we kind of went down a little bit there, but then we actually do get to -2. Okay, cool. It does take a little minute, but we get to point B. Okay, now there's a couple more things that happen in this, but we get to point B. Now, one thing I want you guys to realize, when we get to about right here, you can see what we have. A set of bullish candles followed by kind of bearish candles. Now, this is exactly where that tier list is going to come into play. It's going to be extremely useful for you guys, because if you go in the line chart here, this would be a jagged move. You could argue that, okay, maybe we still want to go lower because we did close through the 0, right? But what did we do here? If I bring back the tier list and everything, what is this? This would be tier 3, where we close beneath, but we fall back above it because it's bearish. I said, you know, we fall back beneath it. That was kind of like for a bullish example. This will be a bearish example. We basically just cannot stay through the 0 here. This is what you do not want to see. It means there's a very high chance of being fake. Whenever you see us not being able to stay beneath the 0, we're going to turn back around to the top, or wherever the standard deviation is supposed to start at. Because remember, the entire point of this is we're saying that this is the bottom. We should never return here until we get to point B, which is -2. That's the entire point. If we can't even get past the 0, what does that mean? It means that we're going to obviously take this high because it's not the top. When you're trading standard deviations, you're basically picking the top and the bottom. ICT says, you know, you're not supposed to do it, but that's exactly what we're here to do. We're here to pick the top and the bottom. And basically, once you get good at this, you will have an eye out for reversals. Now, you do not have to notice this, like, as soon as it happens. You don't have to notice the standard deviation as soon as we close above the 0. It's really for targets. You can notice it when we're way over here and just be expecting us to get to -2 because off the simple fact that we closed above -1. And then we not only did we kind of, you know, close above it here, but we came back and closed above it again. Okay, you should have no doubt in your mind, okay, that we're going to get to -2 or extremely close to it. When you have manipulation legs, or when you're forming one, it should be quick. Everything should be quick. Why is that? It's because this right here, this little up move, and when we come back down, if we came back down quick, it's going to create a higher time frame wick. Okay, we're going to go over that a bit more in a second because I don't want to overly like confuse people here. But this right here, when we do it right, it's going to become a wick. This right here down here is a 5-minute wick. If I brought up the higher time frame candles, you can see this right here. If we even go back further so we can see it clear as day. Look what this looks like on the 5-minute. This little move down here where it's solid candles and it's nothing but bearish candles, and we pop back up above 0. Look what that is on the 5-minute. That's a wick. Okay, this on the 5-minute means that there's a very high chance of us not returning to this for a while until we get to point B. It's a wick. Your standard deviations, the best ones are when it's a higher time frame wick. Those are your best ones because it means we have a very high chance of never coming back for a while. That's exactly where you get us picking in the low of the market where we won't come back to. Now what we're going to do is we're going to go over another example of -1 when we stop at -1, because I want everyone to see what happens, what it looks like when we actually stop there. So what do we have here? This is what's called seek and destroy. And we'll go over it briefly here for a second, but seek and destroy, what it is at its core is non-stop manipulation, which means we do something like this. Okay, what seek and destroy at its core is simply an ascending wedge pattern, basically a megaphone, right? Because it looks like it's getting bigger and bigger. It looks like a megaphone, right? What this is us taking out a high. As soon as we take out this high, we go back for the low that was there. As soon as we take out that low, we go back for the high that was up top. And then once we're ready to break out, we'll continue in that same direction. Okay, cool. When we have seek and destroy, it's going to look like we have multiple manipulation legs. but they're all fake because all it is nonstop manipulation. Like I said, that is the trick. Okay, you do not want to look for standard deviation legs when we have seek and destroy. It's going to be useless. Okay, the reason why that's important to remember, I'm actually going to write this down because it's actually really important. When we are in seek and destroy, standard deviation becomes close to useless. It's because if we're looking for a manipulation leg and seek and destroy is nonstop manipulation, you cannot trust any of this because this entire zone is manipulation. The entire zone is manipulation. Now, technically speaking, you can trust it because once you get good at this, you'll know that this is just a lower time frame, like a 15-second leg, and then look where we stopped at, right? Like I said, it's crystal ball forecast. We stop at -2 and then we bounce, okay? But in the general sense, when you are first starting this, you do not want to look for a standard deviation here because if we're looking for a manipulation leg and seek and destroy is nonstop manipulation, you cannot trust a manipulation leg here until when? Until we close above the 0 and stay above it. Now, what do we have here? This would be a jagged move. Remember the mountain low. We're looking for it to do what? Stay above the 0. If we were looking for one to the downside, what would we use? Well, this right here is a little jagged move. It's a little hump. That's exactly why I drew that one out. Like I said, I don't really need to look at the line chart because I just know. This is a set of bullish candles followed by a bearish candle that just dumps straight to -2. Now you can see that means that we got from point A to point B extremely fast with no entry. Sometimes that happens. But in this example right here, what do we have? We close above the 0, and then we end up staying above it to then try to close above the -0.5. Now you can see here, we actually wicked off the -0.5. Remember what that is. That's our displacement calculator. Remember this, right? If this is our displacement calculator and we can't close above it, it will slip into tier 3. Okay, we kind of went back down into the 0. Now, remember the thing about the 0. This is where it all comes together. If we have two PD rays already at the 0, being the OB and the breaker, right? Every single time we'll have the OB and the breaker. Sometimes the breaker will be a singular candle. This right here, we hit -0.5, right? We hit -0.5. We stop there. That's a displacement calculator once again. But what do we have here? We have 3 PD rays. Remember I said sometimes 3. Whenever you have 3, that's a good sign because what do we have? The OB being the opposing candle as our bullish standard deviation. Remember, think if this was green. Right, we'll put it back green again. Your OB is the opposite color of your standard deviation. If our standard deviation is green, we want to see the opposing candle as our OB. The breaker is the same color as the standard deviation. That's the bullish candle right here. That's our breaker. Sometimes we get the FEG that lines up right at the 0. Look at that. We have the FEG. It's pretty high probability for it to work, especially if you feel like we're going to go up here. Now, the context here is that we dumped and we hit a daily low and that we're trying to bounce. Okay, that's the context. But if we displace over the -0.5 and we closed above the 0 with a strong enough candle, you can already be thinking that we're going to get to -1 because maybe you don't even consider -0.5. That might just be your break even. Now, once we get up to this, your goal, of course, is to get to -1. We actually took this trade, or I called it out on stream. I took it myself unfunded. The little prop block here to get to -1. Okay. Now remember, what we're here to focus on is really truly -1, but it's just nice that we had this little FEG that formed at the 0. You can actually make a model out of this, by the way. The FEG that forms at the 0 is pretty high probability because it's just simply a unicorn setup. That's all it is. The FEG that overlaps with the OB. But anyways, we go up and hit -1, and then we stop. Look at that. We do not close above the -1. Now let me bring back the stuff about -1 here. So remember, if we stop at the -1, there's a very high chance our standard deviation is going to fail the entire thing. And we basically hit -1. I'm just going to mark a line out right here at -1. You can see we didn't close. We close above it. One candle. This next 2 candles are bearish, or they're starting to be bearish. Okay. From -1, yes, it can fail, but what do we need to see? We need to see a whole new bearish standard deviation. If it's going to fail, we need to see a new bearish one. Remember what I was saying in the beginning. When you're looking at standard deviation, you're looking at the outside perspective. We're no longer looking at the PD rays. We're simply looking at the candles themselves. If we're looking at the candles themselves, what do we have here? Straight bullish candles. These straight bullish candles can lead us into getting a bearish standard deviation, pretty much. It absolutely can. And if we get that, then what does that mean? It means this entire thing's about to fail. And so look what happens. We close beneath the 0 relatively quick. That would be what? Tier 1. If I go back to the 0 thing and we bring back the tiers, remember what I said about tier 1. If we close the 0 on the first try or in one candle, that's kind of what we have here. We have displacement through the 0, and how do I know that's 0? Once again, it's just the jagged move like this. Now this would be our bearish standard deviation. Put it like red. So we had a bullish one, and then we hit -1, we stop. If we stop, we have a high chance for the entire thing to fail, which means we'd come all the way back down to this low. And then we can expect -1. This is actually a good example because it's not exactly what I was talking about. Remember I said at the 0, when we'll have the 3 PD arrays, sometimes we'll get the FEG right at the 0. That's not what this is. Yes, we have the OB in the breaker here, but the FEG is not overlapping with the 0. It's simply on the 0. That's not the same thing. Okay, I want to make that very clear. This right here, you can see how the 0, remember the 0 is right here for the bullish one. The 0 is here, and then we have the FEG perfectly overlapping with it. That's the FEG overlapping. That's what you want for your third PD array if you're looking for the FEG. This one right here does not overlap. It's simply like right on the 0. It's like just above it. That's not the same thing. Okay, it's not the same thing. But this could lead us into closing beneath that -0.5, which is still good enough because we already are, just from us reversing here off the -1 and getting the new bearish standard deviation. What does that mean? It means we have a very high chance of running this low because we're simply turning around. We expect it to fail. Okay. Now, once you get really good at this, you'll start to trust the first OB that you see right off -1, and then you can try to take it down to an internal low or even the main low. Remember, it's a cheat code. Just from us stopping here at -1, your eyes should instantly shift to back where we started. Not at this low, but from where our standard deviation is, okay? That's very important. In terms of real liquidity, of course, this is the main swing low. But that's not exactly what we're doing here. Wherever your -1 is from your standard deviation, that's what you expect to fail, which means that would be this low here. Not this one at the main low. We're looking at from our standard deviation -1, wherever that standard deviation started, that's where we're looking for our -1 to come back to. If we reject that this -1 up here, we're expecting it to come back to this low, not this one. Of course, they all end up getting hit, which is nice. Okay, but let's see what happens here. Does this FEG send us down too close to the -0.5? It sure does, and then we get to -1. This -1, when we close through it and get an FEG at -1, when we get an FEG at -1, an FEG specifically. So if there's an FEG overlapping with -1 and we still haven't hit -2, it's even better if we haven't hit -1.5 too. But if there's an FEG overlapping with -1, that FEG should be a silver bullet. It's not a silver bullet in the traditional sense. Okay, let me explain. So if there's an FEG overlapping with -1, like so, you can see this -1, it's like right in the middle of this FEG pretty much. Remember, no different than how the 0 of this bullish one overlaps perfectly, but this one right here is not overlapping. It's kind of just on it. This right here is overlapping, right? If this overlaps, this will be a silver bullet gap. Simple as that. What does that mean? It's not a silver bullet in the traditional sense because it's a silver bullet in the ICT terms is really the first FEG that forms after 10 o'clock or 2 p.m., right? Because that's a silver bullet. That's in terms of time. Standard deviation silver bullet is simply when it overlaps with -1. You can expect that FEG to hold. That's what I'm saying. As long as we haven't hit -2. Let's see what happens here. Does it hold? Not really. Now, the real reason why it didn't hold is because we hit this -1.5. Okay, that's the real reason why. But in a clean market, when we haven't hit this -1.5, if you ever see an FEG right here, it's going to be used as a silver bullet to get us down to -2. Absolutely. This one only failed because we hit -1.5. Okay, we're going to talk about what that one is in a second. But just remember, guys, this -1 thing with the FEG when it overlaps is only high probability if we haven't hit -1.5 or -2. I put only -2 here, but just know, same thing, 1.5. For it to be super good, for you to trust it as a silver bullet gap, you do not want to see it close or even touch the -1.5 if we have that FEG there. And it's very nice when it happens because you can just trust that FEG to hold. I'm telling you, it's amazing. Now, let's talk about what -1.5's job is. If you ever see a stop at -1.5, say we wick off it just like this, you can expect this to go back to 50% of our standard deviation leg. Okay, what does that mean exactly? In this example, it just so happens to be the swing high, but say this was a new standard deviation. Say, for example, we had one here in the middle, just for example. Oh, actually, this is a perfect example, even though it's tight range. Okay, I'm going to zoom in here before we talk about the big one. I'm going to zoom in here for a second, like right about here. This right here, we kind of stop at negative 1.5 before hitting negative 2. What we come back to is 50% of this range on this wick, right? Just from us stopping here, we come back to 50 every single time. That's exactly what this is used for. You can expect this if we stop at negative 1.5 to hit 50, and it's going to be a dealing range play to get back to negative 2. That's exactly what happened here. We jump a little bit past it. Okay, cool. On a grand scale, if we have a bigger standard deviation, of course that was a tight little range one. If we have a bigger one, you're expecting us to get back to 50% from wherever your standard deviation is. No different than how I remember I said if we stop at negative 1, you're expecting the low of your standard deviation from where you created it at to come back to this low instead of the main low. In this example, it just so happens to be a swing high, but just imagine if there's another one here in the middle and we hit negative 1.5, you would expect us to come back to 50 of this range if that's where we had our standard deviation at. Okay, you expect us to go to 50 of this range if we had one here. In this example, it just so happens to be a swing high, so you can expect us to come back to 50%, which means, sure, it's a silver bullet, but since we stopped here at negative 1.5, this would actually be a better inverse to take to get back to 50% of the range. And yes, this works every single time you see a stop at negative 1.5, we'll go back to 50% at least. Sometimes it is a full-on reversal, especially if we have a new manipulation leg that forms. That's kind of why we went higher. But you can see we get to 50% bottom line. And even that smaller example, yes, it works exactly like that. Okay. And in this example, off of this negative 1.5 that we hit to the absolute tick, you can see if I extend this line like this, we've wicked right off it. We're going to go back to 50% of this downward move. Okay. Now, why do we go higher here? Well, it's because we have a new bullish standard deviation. It's like this. And let's see what happens here. Okay, we are displacing past the 0, which means that's tier 1. Remember, tier 1 is where we close above on the first try and we keep going, right? We get to negative 1. We're trying to get to negative 1.5 here, really negative 2 because that's point B. But then we kind of stop at the high, just a little bit. Okay, we retrace just a bit too. And then we're kind of choppy. We're kind of choppy a bit. Okay, now, even when you have standard deviation, like I said, it's still a forecast. You still have to look at liquidity, of course. We basically just swept the high, essentially. Okay, but when we sweep the high, what happens? We create a new standard deviation to the downside. And when we put it back in candlestick form, what should we see? A set of bullish candles followed by a set of bearish candles. And this would be kind of more like a, I would say this is more like a tier 2 or tier 3. What we have here is we close to 0 and we come back a little bit and then we drop down again. Okay. Then we get to negative 2. You can argue that we missed negative 1 here. Yes, we did miss negative 1. It's going to be pretty precise. We at least need to hit negative 1. When you draw it off the way that I'm drawing it here, it's going to be everything is precise, guys. Now, if you're looking in terms of the displacement calculator, the negative 0.5, we didn't displace past it. Okay, so you could be expecting us to get tier 3. You slip back into tier 3, meaning OTE has to hold. If it doesn't hold, we're just going to go back to the high. If it holds, you can best believe we're probably going to try to continue in that same standard deviation way that we're going. Okay, now let's talk about retracement legs, because retracement legs are extremely useful. Okay, say your standard deviation, the first leg at the top, isn't the strongest leg. For example, negative 2 is like right here in the middle. In terms of liquidity, the low is way down here. You kind of want to see negative 2 line up with a low or high, right? Okay, retracement legs are going to be your best friend. Think of it like a prop block, okay? Know how you get an OB off another OB, that's your sign that we're probably going to fly in that same direction you're looking for it to go. That's what a retracement leg is for a standard deviation. A retracement leg is simply your extra confirmation that we're going to go in that direction you're looking at, okay? What I'm basically trying to say is if you have multiple standard deviations in the same direction, pretty high chance we're going to go there, okay? We hit this OTE, we hold it, and what do we get? A new jagged move. The mountaintop. What's it going to be? Start at the top, we go to the nearest hump. Simple as that. How do I know that's the nearest hump? When I put it back in candlestick form, I need to have grabbed the collection of bullish candles, and then we drop down. Now, why are retracement legs so good? Because retracement legs are like prop blocks. It's like a slingshot. It tells you, okay, we have a pretty high chance of going down in this direction. Pretty high chance. And yes, this would be the main leg, the one at the very top, but you can almost expect us to still get to this -2 as well because it is a mini leg. Okay, so we're going to take a break from the levels, what they mean for a second, and talk about retracement legs. There's two things in standard deviation, what I like to call them. There's called a parent leg. That's going to be the main standard deviation at the top or bottom like this right here at the peak. And then we'll get the retracement leg, which will be the second or mini leg. That's going to be your extra confirmation. Every single time we get a retracement leg, there's probably about I'd say 70 to 80% chance what you're seeing is real as soon as we get this retracement leg. Why is that? Remember what I said about standard deviation. When it happens the right way, it's going to be a higher time frame wick. Well, if we have two little humps here, what do you think that looks like on the 5-minute? It's going to be two wicks. It's going to be a swing point. All this is the 5-minute giving us something like this. I'm going to draw it before I even show you because I just know what it looks like. It's going to look something along the lines of this, where we have a bullish candle that gets engulfed by a bearish one to create a swing point. One wick is higher than the other one, and then we start moving lower to basically get like an engulfing candle with a smaller wick type of thing, where it's just a really bearish candle sort of thing. If I put on the higher time frame indicator, that's probably exactly what it looks like here. Look at that. That's exactly what this is, okay? Ignore this little candle here because that's what this high is. We're only focused on these two bearish candles on the 5-minute. That's exactly what this is. We created a swing point. Okay, you can kind of see this little high right here, this candle's high gets swept. That's exactly what this little wick is right here. This wick gets swept. We create another high. That's this wick at the very top. As we come down, move back up again, and then we drop down through it, that's a retracement leg being made. That is the 5-minute saying, hey, we're about to put in a swing point. We're going to drop down, probably try to get to that low or pretty close to it. That's what that is. That's why retracement legs are so useful, because all it is just a higher time frame creating a swing point because we're making multiple wicks. So that's exactly why retracement legs will be your best friend in confirming or helping you confirm what you already believed that could be true. And then if you see a retracement leg, in my opinion, I would just be using the retracement leg here to say that, yeah, we're going to get to that -2. Remember, point A to point B. The point A is the 0. The point B is -2. We should get down to -2. And once again, retracement legs or mini legs will be your best friend. However, the parent leg is what we're being controlled by. Think of it, the best way I can explain it, think of a marathon race where they hand off batons, right? The racer is running up to the next person to hand them the baton, right? As the racer is running up to hand the next person the baton, that person who's waiting to get handed the baton starts running. So that way they don't slow up the momentum. Think of it like that. This is no different than us. When we complete this one, we're slingshotting off of it to handing the baton to the next one. That will take us even lower. That's the best way I can explain it. We're handing off the baton to the next racer to get us even further in the race. And that's why you like the retracement legs as opposed to the other ones. Because even as we come back to this one, let me remove this for a second. All this is, look at that. Look where we stop. -1.5. We stop at -1.5. What are we going to do? Back to 50. Not only do we come back to 50, we kind of hit the last OB. And we hit this FEG that holds price, the OB with it. Why is this FEG so useful? Because why? The 0, it overlaps. This one would be an overlapping one. The FEG overlaps with the 0. That's an important PD ray. It's 3 PD rays in one. It's the bearish OB, it's the bearish breaker, and the FEG. All while we're still respecting the -1.5. I think we may have even hit -2 with this one. Yeah, look at that. We hit -2 to the absolute tick, and then we retrace. Okay. And then we drop down again, making another manipulation leg. This would kind of be more like a tier 2 because it took us a little minute to actually close through it. But once we do, once again, our standard deviation will be like this. Another retracement leg forms. What does that look like on the higher time frame? Another wick, creating just an even deeper swing point on the 5-minute. That's what you can see this wick is. This little move up. We drop down. This is going to be our real leg to say, okay, hey, we should get to -2, or -1, and eventually get to -2 to point B. In terms of liquidity, -1.5 is at this low, which means if we sweep out this low and it's a sweep, we can expect a 50% retrace. Let's see what happens. We end up getting to -1.5. Do we close beneath? This will be the moment of truth. If we do, looks like we might. We do. Okay, cool. Look where we just hit, -2. You want to really make sure you get the retracement legs down, because once we get multiple standard deviations in the same direction, once again, all these are bearish. Okay, I want you guys to understand that. How many bullish standard deviations do we have here? We can count one there, right? This is one. Then we have two here. Then we have a third one here, right? That's 3 standard deviations to the downside. How many to the upside do we have? Only one, if that. This is only one that we have to the upside. That's it. And look where we stopped, -1.5. You should expect a 50% retrace. Really, you should expect it to fail because you only have one to the upside. You have 2 or 3 potentially to the downside. And it just goes in that direction because that's just how many standard deviations we have in that same direction. That's also how you can use it. And once you get really, really good at it, you can even predict the little micro moves like this. Of course, I don't recommend it, but look where we stopped, -1 here. We're going to go all the way back down to the low. And then what does it create? It creates another standard deviation retracement leg to get down to -2. And then you just expect -2 to be hit. Now for the mini legs, you can't really expect -2 to be as powerful as a bigger standard deviation, because it kind of does matter the size of standard deviations. For example, this retracement leg is a lot bigger than this other mini leg that we have here, this retracement one. It's really this retracement leg right here is bigger than even the parent one at the top. But technically speaking, the real parent leg is this one. Now, you may be wondering, well, Plyo, I thought we swept the high. I thought this one was kind of like invalid. Not exactly. Because if the line chart is the only real thing, look what happens on the line chart. Do we actually hit that high on the line chart? No. Which means we're technically holding the structure. We're making, I forget the actual term. A lower high, I think, is the real term. We don't actually sweep this on the line chart, which means this technically is still holding. The structure is technically still holding. That's very important. Which means this is still can be used as the parent leg, truly. And then this would be just a massive -2. And even though this one technically is still a retracement leg, and so is this one I called a parent leg, truly speaking, this is the real parent leg, and all we did was just finally hit -2. Start from the bottom asked, do you TP at -1.5, or how do you manage to trade at that point? Me personally, I like to give it a chance. I'll give it a first try type of chance, or a couple candles. So if we stop at -1.5, like say for example like this when we stop to the tick of -1.5, I'll either trail super aggressively as soon as I see we don't close beneath it. Like for example, I'll have my trailing stop probably at this low or this high right here and just get trailed right there, knowing that we're probably going to come back to 50 if we can't close beneath. Or if we do close beneath, that's when I'll just settle for holding the trade, because I'm like, okay, we close beneath -1.5, we should get to -2. Simple as that. It's just that close. It's just the next level. But if we wick off it like this, I'm already thinking, okay, we can't close beneath it on the first try, second try, I'm going to trail immediately so I can lock in something. Yep, it helps with holding. It gives you conviction as well, because you just know we're going from point A to point B. Absolutely. Now, let's talk about what -2 is, because we keep on, saying point B is -2, but let's talk about what -2 actually is. So really, it's -2 and -2.5, what you're looking for. It's an entire zone. So -2 to -2.5 is our official reversal or retrace zone. Now, notice how I said it's zone. Even though it's still just regular numbers like, -1 and then -1.5. -2 to -2.5 should be looked at as a zone, meaning you should put like a box around it. That's why you always see me on stream put a gray box around it, because this gray box gives us the highest potential for price to turn back around. Okay? Now, what you actually want to see out of this zone is if we are going to turn around, you need to see a new standard deviation if you expect it to turn back around as -2. What does that mean? It means we need to see a new bullish manipulation leg up to the upside. Okay, it looked like we almost had it here, right? You could have considered this as a real one, right? But what happens here is tier 3. We just do not stay above the 0. Matter of fact, we stopped at exactly at the -0.5. OTE doesn't hold. We just close through it. And then we create a new bearish one, and that bearish one should tell us, okay, we're going to go a lot lower, at least to -1, whatever, right? And we maybe get to -2.5. Okay, but truly, -2 should be our official reversal zone. But truly, when we get this -2, you should be expecting us to get a bounce out of it as in a new standard deviation back to the opposing direction is where you started. Now, we don't exactly get that here, okay? We're actually going to walk through this price action like as if I was actually trading it, because this -2 didn't hold. However, it was a nice target, sure, but it didn't hold. So what does that mean? If we don't hold -2 and we close through it, there's a very high chance we'll get to -4. If you see us displace past -2.5, so it's supposed to be a reversal zone, but if you see us, we should be trying to reach for -4. And -4, I'm going to talk about it right now. It should be the end of your standard deviation. So -4 is simply what's called terminus, means the end. That should be where the standard deviation is over. Okay, and that's where you also expect a real strong reversal, because the higher time frame, that should be like -2 of the higher time frame. Okay, now, like I said, I'm going to walk through this as if I was actually trading it. Which leg would I use? Once again, cheat code, line chart. If we're in the line chart, we're looking for the most jagged move that we can see, the most obvious jagged move that we can see, and that would be here. Okay, even before this one, it looks like this one right here would have been a decent one to use. Let's see what that one looks like. Okay, we already hit -2. This right here, -2, it is a reversal or retrace zone. It can also be a reaccumulation zone. Okay, basically what you're expecting is a whole new AMD cycle to form here. That's exactly why we kind of slowed up in this general area and got like this weird type of price action, because we had to reset AMD. We accumulate here, manipulate out, distribute back down. How do I know that's distribution? Is because this right here is our new jagged move to give us a bearish standard deviation like this. Okay, we close through the -0.5, right? Looks like we're going to try to get to -1. Okay, cool. We just hit -1. Looks like we're trying to wick off of it. But you have to think in terms of the parent leg, because what is this? It's a mini leg. It's a retracement leg. Okay, this is just the higher time frame wick, right? The parent leg, -4, is way down here. It doesn't exactly line up with this -2, but it'd be nice if we can hit the -4. If we close through this -1 here, let's see if we can get down to point B. Remember, point A is the 0, point B is the -2. Let's see what happens here. Looks like we hit this, or we got really close to the -2. We didn't exactly hit it. Okay, let's see, give it some time. Looks like we're coming back down, or trying to. The candles are kind of small here. Let's just fast forward a bit. Okay, so we made it to -2 now. Okay, we made it to -2, this little mini leg, from the most obvious mini leg, I should say. Right here, we made it to -2. Now, what did we get out of -2? We actually finally got a manipulation leg, one that actually stayed above the 0 for a little bit. Okay, this right here, look where we stopped. -1. Remember I said there's probably about a 90% chance we come back to the low once we stop at -1. Did we hit the low here? Not really. So maybe this isn't even the full reversal yet. Now, if we close back above this, that should be real, because why? This would just be a retracement leg off of the parent one, even though the parent one's tiny. Remember, the parent leg is just simply the lowest of the low. That would be our lowest standard deviation leg. This would be a parent one. A mini one, or a retracement leg, is simply confirming that we're going to go in that same direction, but just as a bigger move, because this one's so small. It's just telling you where the first leg is going to go, right? The first leg goes to -1. That's probably going to be like a 5-minute wick. If we get this retracement leg, as in a close back above this one, that's going to be the 5 minutes saying, okay, hey, we actually kind of want to go higher now. Let's see what happens though. Do we get the close above? Nope. What just held? -1. Again, we couldn't close past it. Even if you ignore this -1, if you're looking in terms of a retracement leg, what we would have to do to make this a retracement leg? We'd have to close above the 0. Did we close above the 0? No. And if we don't close above the 0, what does that mean? It's tier 3. We're going to come back to the low. Now, in this case, not only did we hit this one, but we hit this one as well, because we stopped at -1 of the parent leg. And then, boom, we dropped down to -4 this. What do we also have now is a bearish standard deviation leg like this. This one would also be another mini leg. Okay. Why is this a mini leg? It's because you can see there's multiple bearish legs right before it. For example, this one right here is more obvious. That's probably what sent us down in the first place. You can see we're just trying to get to -2 of this bigger one. But look at this, what happened here. It looked like we stopped at -1. Remember I said 90% chance that we come back all the way. This one right here, we stopped at -1, but we didn't quite make it there. But we get down to this -2. That's probably where we're trying to get to, right? And if you combine the standard deviations here, the bearish ones in the same direction, using the most recent one that we have, you kind of want to see the -2s line up to say, okay, maybe we actually will reverse this time once we hit this -2 because it's also -4 of this, right? Remember, what does -4 mean? The end. If this is the end of the parent leg that started the entire move and we have -2s down here, remember, -2s are our signs of reversal. There's a pretty decent chance we might actually reverse once we come down here. Let's see what happens. Okay, it looks like we're trying to. Okay, if I ignore that little mini one, it looks like we're kind of holding this one. What do we need to see here? We need to see a new standard deviation to the upside. Do we have potential for that? Yes, because we have a set of bearish candles here. Is it followed by bullish candles? Yes. But did we close above the hump first? Did we close above the hump yet? Not really. Not really. So we need to see us close above that 0. This would be like a tier 2 right now. It's almost turning into tier 3. Remember, what is tier 2 and tier 3? Let's bring it back. Okay, it's like this. Tier 2 is if we take a minute to close above the 0. That's clearly what we're having here. We haven't exactly got to tier 3 yet because we couldn't even close above, but right now it's almost looking like it may even fail. Maybe this is not real. Look at that. We swept the low. Okay, cool. We swept out the low again. What do we have? A set of bearish candles followed by what could be bullish candles. Now all we need to do is close above this. Why is that? Jagged move down, followed by a new move back up, potentially. Let's see. Do we get the close above? Look at that. We got the close above. We displaced past -0.5. What can we expect now? -1 or -2. Okay, this basically is confirming that this might be the real reversal, or it should be the real reversal. Let's see what happens. Look at that. We get to -2. Once again, that's just from simply combining the -4, the parent one, with the little mini leg that was super obvious down here. Okay, actually, that leads us into our final point here. Where should you expect new standard deviation legs form? Higher time frame FEGs for one. Basically, any higher time frame PD array, truly, is where you want to see your lower time frame standard deviation or new manipulation leg, because what this is it's going to tell you how far the 5 minute's willing to go off of this FEG, pretty much. That's what this is. Okay, once again, to put it back in the line chart, we get this little last jagged move. You may be wondering, well, Plio, why am I not using this one? You said it's simply the last jagged move, right? Technically speaking, this is real because we hit it to -4. Okay, but it's too compact. You can see if I put it back in candlestick form, every level is like 1 point each. You don't really want that, okay? I'm here to grab the entire thing. Even if you're not comfortable grabbing the entire thing, because that's a bit more advanced to know that you should grab the entire thing, what can we use? We can use the retracement leg. This right here. Remember what I said about retracement legs? About a 70% chance they're real. Look where it sends us immediately. -2. So now you see exactly why I have the 5-minute FEGs always on my chart constantly. Because all we're doing is we're getting new standard deviation legs out of them to carry price. You expect new standard deviations to form off of higher time frame FEGs and higher time frame standard deviation levels. For example, there's probably a 5-minute standard deviation here somewhere. Let me bring up the higher time frame. So I'm bringing up the 5-minute again, right? This 5-minute right here, actually we'll go back just a little bit so we can see what happened before. Right, this right here on the 5-minute is a leg. If I zoom in here, you can see 2 bearish candles there creates a 5-minute leg. Like this. Look where we stopped at, -2. -2, the very first time we hit it was up here. That's what this is. Okay, we create a new bearish leg off that -2 that sits us down. That's why the 5-minute returned back to that gap at the very first one, because it's like cause and effect. We hit -2 on the 5-minute up here, which is, so I'm simply just marking out the 5-minute of the -2. That's this gray box. We hit that. You can see how well we respect it. We're looking for a new standard deviation to the downside. We get that. We go all the way down to where the 5-minute's supposed to go. That's what this is, guys. It's basically cause and effect, okay? Because the lower time frame gets a standard deviation down here, it's going to cause the 5-minute to start displacing and getting FEGs. Once the 5-minute starts displacing and getting FEGs, we then create a 5-minute standard deviation. Once we get that deviation, you're ready, you're all set. Once we hit the 5-minute standard deviation, we then repeat the cycle. We get a smaller, lower time frame one to start, then it causes the 5-minute to dip back down. Every single move that you see can be explained by standard deviation. The market runs off standard deviation. Never forget it. How to know if your standard deviation leg is real or not, or if it's high probability. For example, if we go back to this on the 30-second, you can see it's multiple candles. Let me get rid of the higher time frame for a second. This right here is multiple candles down followed by bullish candles up. It's not the fastest bullish candles in the world, but it's bullish candles, right? Because remember, we hit this terminus, the -4 here. We had the -2 of the little mini one, like this. And that's pretty much why we had it like that, right? For you to confirm if this is real to the upside, how you can confirm that is if you go on the 1 minute. You should see a leg in the same spot on multiple time frames if it's real. That's why you see me constantly flipping through the 1 minute, the 2 minute, and the 30-second to make sure that we have a leg on multiple time frames. Because if you have a leg on multiple time frames, it's most likely real. It's no different than if you have standard deviations in the same direction to the downside, right? We have multiple to the downside here. We have 1 minute here. We've got another one there. We've got another one, you know, a couple of them in here. That's multiple to the downside. It's the same thing on different time frames. If we see a potential 1 minute manipulation leg, it should definitely be there on the 30-second. Okay, if we get on the 1 minute and the 30-second, eventually we should get on the 2 minute. The 2 minute, that's where you get your singular candle ones from. Because on the 2 minute, this is just one candle. On the 30-second, it's multiple. On the 1 minute, it's multiple. That's how you get the single candle thing. And that's how I know on the higher time frame when I see just a bearish OB, that's standard deviation. What does that also mean? It means that a real manipulation leg on the lower time frame should be a higher time frame OB. Every single time you see a manipulation leg, it should be a higher time frame OB, or it should start to turn into one. Proof of that is even on this dump up here. What does this create? I'll tell you what it should create. It should create a 5-minute bearish OB. Is that the case? Kind of. We have one like right here. Okay, we close beneath this. We play it forward. It ends up holding. Look at that. That's a new OB on the 5-minute. When does that form? It forms when we create this new bearish leg, this one. But it starts with the lower time frame, giving us the standard deviation at the very top, because then it's forming the first bearish will be on the 5-minute, which of course doesn't end up holding. It's just not the cleanest. And basically, once you get the lower time frame to close to the 0 and all that kind of stuff, that's when you should see the 5-minute or whatever higher time frame you're looking at start forming a leg. And that's exactly how you get your major moves. That's exactly how you get market maker sell models and all that kind of things of that nature. Okay, so I'm going to play it back one more time until we get down to here, because I want to show everyone what this looks like on the 5-minute. So we get this new standard deviation leg. We start moving higher. You can see once we get past a certain point, what does that create on the 5-minute? It creates a new standard deviation to the upside. That's exactly why we blew past this -2, by the way. Because the 5-minute now just got a new leg, and it's trying to actually play it out to get to its -2, which on the lower time frame doesn't really look like anything. But you can use it that way. You can absolutely use it that way. When we have a lower time frame one mixed in with a higher time frame one, you can expect it to go even higher, even higher. That also helps you with intraday bias. Okay, it cannot be understated. When you start the day, for example, say on the 1 hour, you can use the 1 hour standard deviation as your guide for the entire day. Say, for example, we have a bullish leg forming. For example, this right here, if I'm on the 1 hour at this time in the day, to keep it realistic, this is like 9 o'clock in the morning, right? This is 9 or 7 a.m. candle. We'll do it like 9 o'clock. What does this look like? Okay, it looks like we have a potential mini leg right here. Okay, if this is our mini leg, we're trying to get to -2. Look at that. We kind of just got there because I kind of fast forwarded a bit. It's like 10 o'clock. But look what we did. We closed above -1. We wicked back down into it to get to -2. Simple. That's your intraday target, -2. Remember how I said this is a mini leg? What would be the parent leg here? It should be fairly obvious from what we've talked about. This set of bearish candles. If you see a full set of bearish candles like this, not a single bullish candle in between, that means that this would be trying to be a manipulation leg to the upside. And if you remember that day on stream when we traded this, I was saying this has potential to become a new manipulation leg all the way up once we close above this. What is this right here? This is 0. It's where this jagged move starts. Sure, you can argue that this is a little hump, but when we put it back in candlestick form, is that a bullish candle? No. Which means we're here to collect the entire set of bearish candles for our standard deviation. And once we get up here, what happened? What happened? We stopped at the 0, and we start to turn back around. What is that? That's a failed CISD. If it's a failed CISD, where are we going? Or where do we have the highest chance to go? Back to where we started. And guess what happened? We dumped all the way down. Now, what truly happens here, this, once again, this is a parent leg now on the 1 hour. Because why? It's a jagged move full of bullish candles. This right here would be like a mini leg. How do I know that? Because you put it back in candlestick form, and you can see this little jagged move here. Once again, that's too compact. And so we are going to use this because it's more so like the set of bullish candles. And we get down to -2. Simple as that. And of course, we close to -2. Probably going to get to -4. Look at that. We get to -4. Why would we go past -4? Because the parent leg, -1, is here. And then I think we eventually got to 1.5. That's where we're at right now. So look at this, guys. This will just be the cherry on top. If this is our parent leg on the 1 hour to the downside, because we've got the failed CISD here, we end up dumping, right? 1.5 here, where should we go? Back to 50% with the entire down move. Does that end up happening? Well, we're about to find out on Sunday Open tonight, because it looks like we're on our way to do it, right? Fairly obvious that we're on our way to do it. This will prove everything what I'm saying. We stop at -1.5 to the absolute tick on the 1 hour. We hold it. We get a new OB. We get a new potential leg to the upside. Not only are we on our way to -1.5, which lines up perfectly with 50% of this down move, but also we could be going up to -1 to potentially sweep out this ITH. Once again, you combine it with the liquidity, you're golden. Because then you have the confidence to say, oh yeah, we're definitely going to that -1 as we close past 50, because that's just an ITH. Should probably hit it. And that's how this stuff works hand in hand. And then, of course, if you see a higher time frame standard deviation, you absolutely need to be looking for a lower time frame, because remember what I said, if you see a higher time frame leg, you should definitely see lower time frame ones. So if we go on the 15-minute, do we have a 15-minute leg? Yes, we sure do. It would be like this. Technically speaking, it would be like this. Why would I not want to use this so much? Because it's kind of compact. I want the whole entire thing because that's really like only one candle. And then we have it like this. Look at that. -1 is here at 310. Why is 310 important? Because that's probably 50% from their 1 hour swing. Oh, wow. Look at that. -1. You see how it's not a coincidence anymore. Because why? We already displaced past 0 first try. That's what? Tier 1. On top of that, it's an FVG that overlaps perfectly. Tier 1. Not only that, but we displaced past -0.5. Not only that, but we closed above the ITH. Pretty high chance we go to 50% and hit this -1, the 15-minute leg, right off Sunday night open. Because at the time of this recording, it's Sunday afternoon. But yeah, guys, this stuff is extremely, extremely powerful when used correctly. And I do want to say, while we wrap it up here, standard deviation is just a tool, okay? When used correctly, it can be used as a crystal ball, but you do not want to abuse it. You do not want to mark out, I would say, anything more than 2 standard deviations on your chart. Meaning you have a higher time frame one like this to keep your bias, and then you drop down to maybe like a 1 minute to confirm that bias by looking for another or the most recent 1 minute manipulation leg like this to go alongside with your 15-minute one. And you can see -2 is kind of close to that -1, which makes sense because we're probably trying to get there, right? That's what you want to see. Remember back to this example. We stopped to the absolute tick of -1. Remember, putting in line chart, we're using it as our cheat code, marking out the hump. We stopped at -1 to the absolute tick. And where did it send us? Back down to low eventually. Then we try to move back up, but what is this? It's a jagged move, sure. But do we stay above the 0? No, we only got 1 candle close past the 0, then we get bearish candles immediately after. What does that mean? It means that this is tier 3. We're not going to stay up here. And then we create a new bearish one. That's going to be pretty much our parent leg or a new mini leg to tell us where we're going to stop. And look where we stopped at. -2. And oh yeah, look where it's kind of sent us back to, -1. So I'm saying, guys, it's extremely, extremely useful. Actually, I kind of had it drawn wrong. There we go. So you can see it sent us. We hit -2 here. We went back to -1. Remember what I said about that? And oh yeah, look what else will happen. This would be an example of a silver bullet. It happens a lot on the higher time frames, a lot cleaner. But you can see, even just from us leaving this gap, even though we hit -2, even though it looked like we were about to bounce, this bearish gap that lines up with -1, that would be a silver bullet bearish gap, by the way. Right at -1, and that's the exact level that holds. It's almost like it's not a coincidence. It's crazy stuff, guys. Like I said, when used correctly, it's like a crystal ball. It is your roadmap. And even this one to the downside, we stop at -1, we get a new bearish one, right? Look where we bounced. -2 again. And once again, guys, this is just a tool, okay? This is the road map. This is not going to work 100% of the time because there's always failed CISDs everywhere, right? For example, this one right here is a failed CISD. We couldn't close back above, but just the general knowledge of you knowing what to expect after a failed CISD. I even said this on stream. I told everyone, okay, this looks like we're about to put in a swing high right on this candle at the 2 p.m. candle. I don't know if you remember that from stream. I even said it. We're probably going to make a 1 hour swing point here. And then we start dumping, and then just from us dumping from here, making a swing point, we can expect, okay, if 50 doesn't hold, we're going all the way back down. Okay, overnight, it looks like we're going to hold 50. But as we dump through it, we're going to go all the way down to this swing low and then this one, just off a failed CISD from the very top. And once again, you don't have to think about the pity rates at that point because you know they're just useless. They're just going to break. As soon as we don't close above this, they're just all going to break. It's just over. And that's why it's just so, it's insane, guys. It is. And remember, it's just another tool, and you should only have 2 max is what I recommend, so you don't get what's called analysis paralysis when you have too much on your chart. So for example, you don't want to have this right here drawn, and then this right here, like this bullish one, and then also like another bearish one. That's going to be too much. You're going to get too much, like it's just too much, okay? 2 max is what you want to have. Only 2 of them max. Higher time frame one and then like a lower time frame one, that's perfect. You're golden at that point. But yeah, guys, that pretty much wraps up the standard deviation masterclass. Hopefully you guys all enjoyed. Hopefully you learned a thing or two about standard deviations and how to use them to your advantage, because it is extremely powerful and useful when you draw it off the line chart. Absolutely. But yeah, guys, that's going to wrap it up for this class. Hopefully you enjoyed, and we will see you all tomorrow for AM stream. Peace.